Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Hello, and welcome back for another weekly market recap. A bit of a relatively calm week. Markets didn't move around a lot. If not for one market specifically, it must be, 2025 is the year of the orange, right? You got the orange men, and it looks like the only thing moving, it's the orange coin. So, at least, the only thing moving in a way which is kind of conducive to what people might expect from markets. Okay. Now, without further ado, let's jump into the economic calendar and let's see what type of week we had. A bit on the light side, even for the news and the data points coming in. Of course, we got PMI on Monday. For the US, they came in positively. Of course, this is the fusion index, so everything which is above the 50, it's considered to be an expansion, so therefore good news, right? Was expected at 50.6, came in at 51.6, and the previous read was a little bit less than 51. So again, positive one. Might also be another tell if you didn't have enough to kind of grasp what the FOMC decision would have been as for interest rates. Okay. Tuesday, not a lot. I mean, it was kind of telegraphed that as for the US, the balance of trade would have been negative because, of course, we already seeing that with the GDP number last week, it was negative because a lot of it was some sort of a fake out or a quote unquote corrupted data by the huge amount of import, so the front run of tariffs. So an increase in imports, and therefore, you see the balance of trade, which it was negative 123 billion previously, and it just increased into the negative side, reaching into 140 billion negative. I mean, widely expected again, which brings us to the more juicy stuff for the week. So the Fed announcing rates again. I guess the attention was all on what Powell would have said rather than the decision itself. At this point, it's kind of clear, as we stated many times, that the way Powell it's usually conducting these meetings and therefore the press conference is always trying not to surprise the markets one way or the other. He doesn't want to spook them. So again, no cuts, no hikes, rates remained where they were. And even in the conference, I mean, it was a bit in a no man's land, kind of a nothing burger, but we might dive a bit more, a bit deeper into it later on, right? What else? We got an interest rates cut in the UK. I think I remember that. Yeah. From 4.5 down to 4.25. So 25 basis points cut. It was, I mean, even in here, it doesn't take a genius. You see that all the other central banks, from Canada to the ECB to Korea, everyone is cutting. And therefore, at this point, even if initially a few months ago the Bank of England was a bit reluctant to start cutting, now they're acknowledging the fact that they need to ease. Okay, so again, nothing new, and I think what was that? There was an interesting point about these central banks now. Oh yeah, the Swiss central bank. So down in Switzerland, or relative to my position, is up there in Switzerland. They are about to break down or breach in again through the zero rate, so the zero boundary. Okay, they're pretty close, and I guess my bet would be they're going to be in negative territory soon enough if things keep on going like this. So just out of curiosity, the Swiss central bank, it's already at the edge of negative territory as for rates. We'll see how long before even the Fed will start to cut. But for now, no. What else? We got a few Fed zombies talking on a Friday. And what? And then what? Nothing else. I mean, we got. Oh, I just skipped Thursday. Yeah, my bad. I mean, I skipped it for the US. I was talking about the UK. Continuous jobless claims. That's. I mean, the headline for initial jobless claims, it wasn't particularly relevant in my view. But the continuing jobless claims, let's look at them for a minute. Let's see where they are relative to the last, what, 5 years maybe is a bit too much. With 3 years, uh, still hovering around these levels, but the 4 week average, I guess that was the one which it might look a bit more alarming if you check this chart over here. So again, you can say if you try to imagine some sort of a trend line in here, starting from July 2023, you see they are on some sort of an upside or upward trajectory. So uh, even on this one, more on it a bit later on, but I keep on thinking that the labor market is weakening a bit, no matter what Jay Powell is trying to communicate us, right? And that was basically all as for the economic calendar this week. So let's have a look at the charts real quick for the first ones. So the dollar was kind of as expected. We were looking for a bit of a continuation in these bounds. It started out Monday, Tuesday by actually dipping, but we kind of held the structure at this point, higher highs and lower highs, and we got back into that pocket we were looking at in conjunction with the low side of the range as for the macro range that we always reference. Uh, I don't think there is a lot to say on the dollar at this point. I mean, I guess at this point the thing is to try to establish if we can really extend these bounds and getting back into the range, and therefore confirming that it was it was all a big fake out to the downside, and probably over the next few weeks and months the dollar will keep on hovering around this macro range, or if we can see a sharp rejection here, and therefore the dollar keep on plunging. I quite honestly don't, at the current moment in time, I don't have a strong opinion in the short term. Um, I'm always brought to think that, you know, broken support, more often than not, it tends to become resistance, at least at the first retest. So, I wouldn't be surprised to see a bit of rejection here. But what would be more important for me would be to see if we can actually have continuation. And at this point, if you really believe this chart it's really bearish, you would like to see velocity on top of the rejection, so a sharp rejection at this level right here if it is really really bearish. Okay, other than that, if you, let's say, over the coming let's call it 2 4 weeks, maybe let's call it a month, right? If you see a rejection here but then price failing at continuation and facing, or coming back into resistance again, at that point, again, maybe this is not the time where the dollar is going to die. Of course, as usual, we have been hearing about the collapse and the demise of the dollar for so long now. It's almost 60 years as far as I can remember, although again, I wasn't alive 60 years ago, but as I always say, I can read. Okay, so if you check a bit, the idea of the dollar collapsing was postulated almost 60 years ago, and so far, those supporting that idea have always been wrong. So, as I always say, it's kind of the safe thing to do to bet on this time is the same as any other in the past. rather than this time is different, right? Let's have a look at the other currencies. Now, I guess even in here, pretty much what expected. The euro, a bit of weakness. We kind of, I mean, for now at least, confirmed these apex base right here, and we kind of breached it. So you see, we broke down, kind of retested it on Friday. We have been rejected so far. The good thing, if you want to be bullish the euro now, is that it might get a bit lower than this, but we should expect a little bit of a support around the what 1.10, 1.8 level, kind of like in this pocket right here. So, if you want to be bullish, the euro, that's where you might want to look for. The pound, it's kind of the same. It's kind of confirming the same structure of the euro and mimicking what on the opposite side the DXY is doing. Same for the Japanese yen, as you can see in here. They are all basically following the same type of structure. Canadian dollar, if you remember, we were looking at it saying, yeah, I mean, we might get a bit more of a push, but wouldn't be bad to see it drawing back a bit, kind of, you know, picking up a bit more liquidity to the downside. If you really believe we still have more upside medium term, so scooping up a bit more liquidity and then reaccumulating and trying for another push to the upside if you want to be bullish. Otherwise, I guess the same analysis you can do for the rest, it's valid for the dollar Canadian at this point. Even in here, I mean, as for a realistic first or expected support, you don't have to draw back a lot from here. 1.40, 1.41 maybe. That would be your first area of support. It's kind of a large area, all things considered, but you could start to look for an eventual bounce around that region, I guess. The Australian dollar so far, uh, we actually tried to break out of these previous support and now turned resistance. So far, we kind of deviated above it, and then we just fell back into the previous range. So I don't know. I mean, at the end of it, it looks like the Canadian dollar. It seems like the less bullish, so to speak, uh, among the pack here. So not cool for the Australian dollar here, I guess. Now let's move on to the other currencies. Again, even here, not a lot. We have seen what the Brazilian real had no, the Indian rupee had a little bit of a dump. I guess, as you can imagine, might have been due to what's going on in between India and Pakistan at the current moment in time. Uh, I don't know. I don't know much about what's going on actually. I just hear that there was some sort of a terrorist attack or something like it. And again, I'm saying just speculations because I don't actually know. I didn't have the time to document myself on the nuances of what happened. But I guess it's always the same, right? There are tensions in between one country and another, and then it just take a tiny little spark to, to set everything on fire. We'll see how it's gonna go. Oh, I was just reading Trump tweeted that thanks to the intervention, diplomatic intervention of the US, the two countries agreed on a temporary ceasefire. So I mean, I don't know. We'll see. But I guess if you're looking for a reason for volatility in the Indian rupee, might have been that. As for the volatility in the Chinese yuan, as you've heard, there was a very strong rumor, which was then confirmed, about talks in between the US and China on the tariffs and all the trade war. And I guess, what time is it? It's past 4 p.m. So I guess at this moment in time, they are preparing for these talks, or they're already talking, maybe, I don't know. But the two countries, You know, as for the US, it should be Besant, and another one. And as for China, I can't remember the name, but you know, the two diplomatic factions are set to meet up in Geneva, in Switzerland, right while I'm talking to you right now, at least while I'm recording this. So we'll see what's going to come out of it. Uh, Probably might be much more relevant for the stock market rather than the currency market. But you know, I guess these relief rally in the yuan could have been on the back of trying to front run a potential reduction in the trade tensions in between China and the US. Probably the rest it's kind of the same. No huge news here in my view. So let's move on to oil. Now, oil was kind of funny because we were looking at this dump, the pullback, and the potential continuation. But if you remember, what we said was, I mean, opening up the week, if you expect continuation from here, it's better if you have it sooner rather than later. You want to see it going at this point. And it looks like, the opposite scenario, or at least the alternative was otherwise you might have some sort of a double bottom in here and oil going for a little bit of a rangy behavior, range bound environment. Again, it doesn't happen so often that, it gets so precise, but it looks like a real double bottom. The two spikes to the downside are kind of at the same level. The week opened up with a gap to the downside, but it was immediately clear, right? Monday, Tuesday, we just pumped. Then, we've seen on Wednesday a bit of rejection, and then on Thursday, Friday, continuation to the upside. So you could kind of split it like this if you happen to see it once again, right? You might want to take this range right here. I'll try to draw it like this, for instance. So when you see price leaving this range, you got an inside bar here, right? So then you gap down. So that's again right where you want to see continuation, because otherwise what you might get, like in this case, which is, of course, it's easy in hindsight, but it's just a matter of assessing the odds of something happening over another. But if you see price gapping down and immediately snapping back into the dealing range in here, and then you see it was rejected partially, but again it kind of held the region right here. At that point you kind of start to look like to think about, yeah, you know what, we opened back down, immediately got back in, and we weren't able to have continuation lower on Wednesday. I might prepare myself for a bit of upside Thursday and Friday. Like in this case was Thursday and Friday, but it could be whatever other day of the week. It's just a pattern, right? um, I do like that type of a framework when you describe these things about what is the market doing, right? Like in this case, it's coming down. Uh, what supposedly what the market should do. If it is coming down, it should keep on going down, right? And how good is the market at doing what you think you're doing or what it is supposed to do? Like in this case, how good is this market to keep on plunging? Well, not a lot, right? Gap down, immediately back in, and it got stable into the range. So that's your telltale sign that maybe this market is not ready to collapse yet. And actually, this increases the odds of a little bit of a mean reversion. So if you try to draw a little bit of a larger consolidation in here, again, you see that basically we are in the midpoint of the hole, right? So again, I guess if one it's not true, it might be the other. So in this case, no continuation, back in the range, and we'll see what next week will bring. So the obvious thing would be at this point, failure to the downside. It wouldn't be unusual to see a run for the highs, not necessarily breaking them, but just revisiting the area. in the context of a range-bound environment, or otherwise, keep on staying in this range. Overall, it's not like everything drastically changed. It's still the same weak oil for now. And I was reading what the OPEC is doing. I hinted at that in the past, but they just, the OPEC is kind of a complicated type of cartel, right? They are a cartel on paper, but they always try to to screw the other in between the same cartel, right? Because it's just a matter of, yeah, we are a cartel, we should be in agreement, but at the end of the day, what I do care is to sell more oil than you so that I can make more revenues than you. So currently the Saudis announced a bit of an increase in oil production to kind of punish a few other countries of the cartel, which were allegedly accused to, not respecting the quotas, so to speak. Um, there is a little bit of a political spin on it too. The Saudis are actually doing this because with oil particularly weak already, and with Donald Trump again, quote unquote, demanding for oil to get back below 50 and possibly into the 40s, if the Saudis can help out with that, they might have a special treatment when it comes down to tariffs and the trade war, or again, their positions of favor, when it comes down to the relationships with the US. I know it sounds a lot like conspiracy theory, but I'm just saying I'm not naive enough to think that these things wouldn't happen, like ever. So, I might actually believe that. It, like to me, it actually makes a lot of sense in the context of the current geopolitical environment and whatnot. So again, just take it as you like, but just remember it can happen. It is also true, as we stated, that you might want to bring down oil prices and therefore the energy prices, because especially in the American from the American point of view, that would help a lot in bringing down inflation, therefore giving the Fed a reason to cut. And therefore, if they cut, maybe they signal the market that interest rates are ready to fall again. Ideally, the signal from the Fed should signal the bond market that now they can bring rates back down, and therefore the US government would be able to refinance those 7-10 trillion debt maturing this year at a much comfortable and lower rate. A lot of talks, all to say that, yeah, it's easier said than done. Okay, especially because it might be good for the American consumer as a whole, but it's not good for those enterprises and companies which are actually extracting oil out of the ground. And we already, monitored the break-even point for these companies. So it is also true at a point you might say, you know what, in the context, if you remember, of what GDP is for, it might be for the greater good that currently the oil companies need to take it on the chin and take one bullet for the team, because we need to bring inflation back down more than anything else. And we might subsidize the oil industry. We might help them with, I don't know, tax deduction or exemption or whatever you, or credit, whatever it takes, but we need to have energy prices down first and foremost. As for the rest, we can manage it in other ways. So that could be one narrative if you want to believe that, and all the different ramifications as you just heard. Now, as for interest rates, again, nothing. I mean, again, they bounce back up, right, this week, but if you zoom out and if you look at the long end, we are basically still operating in between these high and these low. So we are still trading in between this dealing range right here, from here up to here. So we tested the high side of the range, we tested the lower side of the range, and we didn't break out one way or the other. Neither we broke out, neither we broke down for now. As for the medium end of the curve, It's kind of the same talk. Still a little bit of a rangy behavior, but in this case, it looks a bit less bullish than the long end. And again, if you check the short end, it's the one which, on the opposite side of the long end, it looks a bit bearish. Okay, just remember now the 2-year Treasury closed the week at 3 point, call it 3.9. All right, Fed fund is in the 4.25, 4.50 range as for Fed funds. I mean, that's what, 50 to 70 basis points delta. And again, if you remember that chart we were looking at when it comes down to the historical relationship in between the 2-year Treasury yield and Fed funds, you do remember who's leading who, right? So give it time. This is not something which is going to happen overnight, but I almost hate to state it once again, but I keep on thinking medium to long term rates will be lower, right? Even if you don't have a recession. If you have an actual recession, all bets are off. But even if you don't have a recession, if you achieve the glorious soft landing, I still think rates should be lower. That's just a fundamental factor, right? The 2 years is where it is. The inflation, it's a what? 2 point, I don't even remember. It was below 3, but I don't remember the last print. Maybe it was 2.6, something like it. So again, how can you have Fed funds so high, right? I know Powell is talking about the potential risks of tariffs to be inflationary. Okay, how long, right? For how long? So again, I don't see a runaway inflation. I don't see rates getting up to 6, 7, 8% as other people are calling them to be at. So that would be me. No need to talk about the bonds because of course it's gonna be the opposite of interest rates. Let's have a look at gold instead. Now, gold was interesting because we closed down last week at this level right here with this doji candle right here, right? So the assessment was, we discussed first and foremost, do you really need to touch a level? And we were looking at these. And again, we are now looking at these, and you see that these huge bounce came off of, well, not a real test into the level itself. What was it? I mean, what type of you know, some sort of a $7 type of a spread in between the wick down and the actual level we highlighted. So still, keep on thinking about these lines more as of a region, as an area instead of an actual line in the sand. Okay, but nonetheless, we got a nice bounce in gold, especially Monday, Tuesday, and then a bit of again a rejection. So the the thing is right now is we didn't break down. So, those targets we were looking at as potential buying opportunities into this range right here weren't actually met because we just bounced. On the opposite side, we actually didn't make new highs. So again, the final point was, if you remember last week video, it's not unusual for gold after these huge runs to have a period of, sometimes it's just a month, sometimes it's 2 months, a period where it might get stuck into a consolidation for a little while. Now, this has been just what, basically 2 weeks for now, kind of like that. So it's too early to tell if this is the case, right? But, at least for now, what we can say is that we just established a new range. This is your high side now. This is your lower boundary now. And up until the point we get out of this range one way or the other, I mean, given the current trend overall, you might say I'm still bullish, of course, given the fact that if you zoom out a bit, would you be bearish on this chart at the current moment in time? Like, I don't think so. But, very short term, we might say neutral for, let's say, the next 5 trading days. As for the next month, probably still more on the bullish side of things, right? Up until we start to crack a few relevant levels to the downside. So we'll see about gold. Now let's move on to the star of the week. Glorious rally in Bitcoin land. Now, shit, last week it was actually here. It was actually drawing back to the downside. So we opened up at what? 94 something, and we closed at what? 103 or 103.5. Not bad, not bad, right? But again, we were discussing the fact that we left out this gap right here. We reclaimed this level right here after, again, drifting into it. Like levels like these, they usually work way much, way better if you got a sharp move into them, like we've seen in here, and an immediate rejection. Instead, if you approach them and you start to drift into them, like you've seen in here, we are just eating up all the liquidity on the sell side into the level. You see, we get one tap into it, another, and every single type of rejection was quickly absorbed. And that's where we actually turned a bit more bullish on it. Not only because we reclaimed this area right here, which was the overhead resistance, and then when we finally, with a sharp move, broke above the level, we came back into it, retesting it. At that point, the bias was there is a little bit of a gap risk to the downside, but I mean, remember last week, it's not mandatory that you need to fill it in. It's just one risk you would have, one risk less you would have to be worried about. But, as I said, in case you already bought, I guess you don't care. And still, the potential for upside, it's nice. Lo and behold, 4 straight days to the upside. A little bit of a started step on Thursday. No, it was, oh, yeah, it's 24/7 market. It was Friday. Now it's Saturday. Okay. So the targets we had were in here, basically, in this region. So in between basically 100K and 101K, more or less. But that 100 and sorry, 1,500 or slash $2,000 range was far exceeded, as you can see. Now, if you try to zoom out a little bit, I want to try to do this. If you go on the line chart, right, and you start to look at things, of course, you're going to lose a bit of accuracy by doing so. But, oh, well, gentle reminder that, although all the talks about Bitcoin being bearish, if you zoom out on a weekly time frame and you put it like these move to the downside, was it so bearish? I mean, we were talking about it, I guess, well, probably in February when we were discussing the structure of the overall market, the cup and handle, and then, the continuation to the upside. So, I mean, was bearish short term, but overall, right? So if we try to do something like this, let's have a look at some Fibonacci extension, just for, bullish porn in this case. So you take the origin of the move, you go to the top, and then you highlight your most recent retracement. So should we go where? Well, 110, 116, 117 maybe. Well, wouldn't be bad. I mean, it would be in line with the extensions, I guess. Um, I don't know how much it would take to go there, to be quite honest. Because, I want to see what's going to happen in relation to the stock market now. Again, not to bring back the talks about decoupling and whatnot, but I just want to see if the stock market is going to be able to follow up what Bitcoin is doing, or let's say if the stock market has a bit of a retracement now, let's say in the rest of the month, throughout the rest of the month, I want to see if Bitcoin can hold it, which for me would be basically maybe having a little bit of a pullback, getting back to, I don't know, 97, 96 maybe, and holding that region and keep on pushing to the upside. Or if we are so fucking bullish now that we just go for another brief period of consolidation and sideways action before the next push to the upside. I I mean, I do believe targets in between the 115 and 120 regions are all legit. If this move keeps on going, I wouldn't see why not. Um, I'm just thinking at the same time, this is some sort of a, I know it's a bit of a leap, but it might be some sort of a moment of truth, at least, for the very short to medium term. And what I mean by that is, if you want to set up a bull trap, this is actually the best spot to do that. Either here or kind of, no, I wouldn't believe in another swing failure of the highs. We already had it. So I guess, if you want to set up a bull trap, this is a good place to do that. But quite honestly, that's not my base case. I don't necessarily think we're going to see a bull trap right here. And even if we do, you would really need to break back down below 93 in order to confirm that. So I mean, it's like a $10,000 move from here. So yeah, I mean, just the bull trap right here. Although I entertain it as a possibility, I don't see it particularly probable at this stage. I don't think we're gonna see a bull trap right here, or let's say over the next 2 weeks, most likely. Um, yeah, anything can happen, of course, but that wouldn't be my base case right now. I think we actually keep on pushing a little bit more to the upside, especially if the stock market can really put itself together. Or, I mean, again, even if it doesn't, right? Just because I'm not fully agreeing on the decoupling, and I think you would need to establish that on a much larger time frame, like a quarter or 2 or 3. uh, if it has to happen, right? It's got to start somewhere. So again, I'm not completely close-minded to the fact that at a point they could decouple. Um, I'm just saying it could take a while, but I mean, you know, everything starts somewhere, right? So yeah. So enough for the first part. The usual brief pause before coming back with the equity market, um, and we'll take it from there. Okay, so before we actually check the chart as for the S&P and the Nasdaq, let's just have a step back to what Powell was talking about throughout the FOMC meeting, as I hinted at the whole thing in the beginning, but didn't really elaborate that. So a bit of for a little bit of a recap of a few comments and quotes he made, and I highlighted what kind of made me laugh a little bit, right? Because if you start reading through, right, okay, like the first one, price changes due to tariffs could be short-lived or persistent. Hmm. So okay, could be white, could be black. All right, okay. Yeah, they are well positioned to respond at whatever type of development. And they are waiting for the assessment of the impact of tariffs before reacting. But at the end of it, we are the most powerful entity on the face of Earth. So whatever we do, doesn't matter the timing, we can always fix it, even if we break it first. Okay. Now, he, of course, he appeared concerned about the tariffs, but because he's linking them to inflation. But again, doesn't take a genius to go back in history and see what type of effects you had with tariffs in the past, right? And he stressed because they cannot predict monetary policy. Hmm. That's it's a fair assessment, but it's nothing new, right? So, and this is where I really started to laugh while I was looking at the press conference. Like, it's just there are cases in which it would be appropriate for us to cut, but there are other cases in which it wouldn't be appropriate for us to cut. So we don't know. Sorry, what? Uh, how many thousands of PhDs in economics you have working for you? And yet, this is the best you can come up with? We just don't know. Or, yeah, I mean, could be white, could be black. Oh, you know what? As for tomorrow, well, I mean, it could be sunny, but could also rain. So I don't know. Just take your sunglasses, but also take your umbrella. You never know. Thanks for nothing, Jay Powell. And again, a little bit of a joke at the end, maybe a little bit of a hit back to. I mean, I guess it's not easy to be in his position right now when all the questions are about, would you think President Trump would fire you? Of course, right? We don't need to give Congress budget advice, just like we don't need them to give us advices on monetary policy. Yeah, of course. Now, so you can already see that uh, it was a nothing burger, right? As I was saying, a lot of talks for saying nothing. The thing is, although I always believe that he can't really say what he thinks because otherwise he would probably, not absolutely, but probably end up being the catalyst for what he's desperately trying to avoid, right? But he can't say, I mean, I'm not going to read through it all, but just I'm going to scroll it very slowly so that you can read what we're talking about here, right? We are talking about revisions as for the labor data. So, I mean, although he said the labor market is solid, resilient, yeah, maybe a little bit of a slowdown here and there, but overall, there's nothing to be worried about here. Just move along. There's nothing to look at here, right? Okay. But the data and especially the revisions that the same BLS is doing right now are not really supporting his confidence in the labor market. So, I mean, again, if you want to read these charts, I know they are a bit complicated, a lot of columns and whatnot. I'm not in any way, shape, or form better than you at reading a chart. So instead of talking for another 10 minutes about this, you can just, can screenshot the whole and read it for yourself. But the gist of it is that at the end of it, it's not so guaranteed that the labor market it's as strong and resilient as Powell is trying to describe it. But again, he can't do it otherwise. He can't talk otherwise. Would you imagine Jay Powell coming out? We're not going to cut rates, but oh, by the way, for the data we got access to, we do think the labor market is fucked. And since, everything else is kind of fucked already, from student loans to credit card delinquencies to car loan delinquencies to mortgage rates applications to retail sales, this is just the last shoe to drop. So I don't know, buck it up. It's gonna be a nice road here. I can't do that. I can't say that. Otherwise, the stock market would sell off tomorrow morning, right? This is just what they are. I mean, forced to say at a point. They're just trying to save the situation. This is everything they got. I mean, there's the forward guidance, the psyop, the psychological leverage that they got. That's everything at this point. Forget QE, forget QT, forget rates. It's just the biggest psyop of all time. This is what central banking is all about, in my view. 95, 99% of the time. Okay. Now, sure, if you tell me, well, the market is collapsing, but if the Fed is starting to buying, 200 billions a day of treasuries, yeah, sure, they're going to provide liquidity that way. But what they're doing is just trying to repair a tank which has a hole into it, and they are trying to pour in water in a tank with a hole in the bottom of it. So the more they pour in, the more it is going away from the hole. It's kind of the same thing, right? So and this is just a few charts to corroborate what I'm talking about. Of course, it's very slow and it's very medium to long term, but I mean, the macro picture is not that rosy. And again, if you pair it up with everything which is going on when it comes down to bring back manufacturing, bring back jobs in the US, this is basically why. I mean, this is not something which happened just with Biden. It's not something that happened over the last 5 years. It started way back in the past. But this is just how the system is structured. When you got a country which is the world reserve currency, which needs to keep on flooding the world with the currency because the world is levered up on the US dollar, right? And everything is basically based on that. It's just natural that that country which is holding the global reserve currency, is going to have a massive deficit compared to all the rest. That's how the system was set up. And I know at a point it becomes unsustainable, but it was the Americans which set up the system this way initially. So, I get it. I get why they want to change it now, but they just, it's one of those things. We do it because we think we can exploit the system as we set it up massively by printing to infinity and not being held responsible for it. Oh yeah, but we are gonna be biting in the ass from another perspective. Which what would it be? Yeah, we're gonna lose a huge amount of jobs, and we are not gonna be able to produce our own stuff, and we're gonna be dependent on the rest of the world to provide us with them. Yep. So it can last as long as you want, but at a point it's gonna end, right? Or at least at a point someone will be tired of it. So again, if you keep on looking at this chart, they're all telling the same story. And when I hear people talking about, yeah, but now we're going to have AI. Yeah, AI, it's going to be great for corporations and companies because they're going to boost their profits hugely. You know how they're going to do that? They're going to buy an AI agent, which is going to be able to do the same job. No need to sleep, no need to eat. He will showing up at work 7 days per week, 24 hours a day, no security, social security, no injuries, no healthcare, no nothing. And they're gonna probably fire half of the workforce. So yeah, AI is gonna be great. If you, I mean, if you like to be unemployed and maybe relying on UBI and be some sort of a slave to the government at that point. So I guess it's just I don't want to be pessimistic, but this is just the dark side of AI that no one is willing to talk about. I mean, in generally speaking, right? I'm not saying there are people out there and all of them are stupid and I'm the only one smart enough to figure that out. Actually, I'm just reporting what I heard from other people which I consider smart enough. So it's just a narrative which is a little bit in the backseat, and no one is really willing to talk about it. But the narrative is pushing through as that's the greatest invention after the internet. Yeah, sure. I mean, it's going to be. Probably it's not going to be a benefit for everyone, right? Now, let's finally move into the charts as for the stock market. So as we were saying, sorry, not a huge week. We basically opened up on a downward trajectory on Monday. It was on Monday, Tuesday, down. Then we had this reversal on Wednesday. Thursday was up, and Friday was just your indecision Friday, very choppy market. Uh, the stock market didn't really go anywhere this week. It was just in this range. And if you check the last Friday candle or range, we basically traded in between it. We literally didn't go anywhere. Now, when you zoom in, let's say on the hourly time frame, and as you can see, we got S&P futures on the left, and this is Friday, and then there is the week was the Nasdaq in the center, and the Dow on the right. So that was your Monday. So you got your weekly open, down move in Asia, opening up, getting back into it, in the US session being rejected and down. It was as the S&P and the Nasdaq. The Dow was a bit stronger relatively, but at the end of it, it followed the same type of a direction overall, right? Now then we go into Tuesday. It was a down day, but then we got a bit of a spike to the upside. Now here is where it got funny a bit in my view, all right? Because what we've seen is essentially um, how would you call that? The announcement of the announcement. So we got the talking about a trade deal established or in you know coming in with a huge nation. A few hours later, we found out it was the UK, which is fine. I mean, it's still positive news, I guess. So the market started to rally a bit. Um, but then of course the market pulled back throughout the rest of the day, as you can see, especially here. And then, at the end of the day, we got this massive spike and run to the upside all throughout Asia. That's where the market actually realized that the deal was true, was coming through. But guess what? You know, for the rest of the day, the market just pulled back the entire move to the upside. And actually, we traded back into the origin of the move. To me, this is not a very bullish behavior, right? It's not what you want to see if the market is really rallying. I'm not saying that, given this fact, at this point, the market will reverse. I'm just saying we are still in this headline driven market. So it just take one piece of news, the market will run like this, and then we'll spend the next hours just drawing back the entire leg as if it didn't happen. So just don't be caught in the heat of the moment, especially with these news which are continuously coming in. That's what I guess that's what I'm trying to say. All right. So let's move on a little bit. Now, let's have a look at the ETFs in this case. Now, as you can see, we were looking at this region to the downside as an invalidation for the uptrend for now. But at the same time, we got overhead resistance, both for SPY and the NASDAQ. We didn't really get to those levels. We didn't reach into those targets that we had, nor for the upside, but at the same time, neither to the downside as for the invalidation. We hovered around what was that? The 55 exponential moving average on these, dump of basically Monday, Tuesday, and we held that moving average for now. So it is constructive to some degree, same as we reclaimed the 21 exponential and then we tapped back into it and we bounced. In this case, we reclaimed the 55, we tapped back into it and bounced. Not as, not the same type of convinced bounce, but nonetheless, a little bit of weakness, in my view, was expected, which is why the video of last week was entitled cautiously optimistic. Now, you need to remember that we had a good amount of days of advances in here. I guess it was 9 days where the market was only up. Now, I know if you look at these, you might say these candle right here and say, hey, yeah, but that was a bearish candle. Just give me a minute. Anyway, when you talk about these series of advances, at a point they come to an exhaustion phase, and this was historically a good one. So it was natural that at a point you would have had a bit. Just because people say expect a bit of weakness, it doesn't mean reversal. You know, it might just be that we are gonna be stagnant for a little while, but it doesn't mean you're gonna reverse when you just because you say weakness. So again, this is just to recap also the reasons behind the cautious optimism of last week, right? Now, overall, as I hinted at, we are still in May, and May historically is a good month for the stock market. An interesting point is it's a good month, especially in those years after election. So again, another reason to keep on staying on the bullish side of things here. Again, I'm just trying to take out the different perspectives, both for the bulls and the bears, right? If you remember, we were discussing as well the earnings. Now, we are going to have a bit more earnings next week, but nothing really relevant. The majors already reported earnings, and as we discussed, it wasn't as much as a matter of the actual figures, rather than the guidance and the fact that the corporate share buyback window is gonna open up again. So huge amount of volumes coming into the market, and historically, when you got buybacks opened up, let's just say it leans a bit more on the bullish side, right? Because you got more buying pressure, right? We also hinted at the fact that throughout all these down moves, the ones buying the dip were basically the retail investors. While instead, if you check the flows, the you know the pros, the institutionals, they were caught a bit offside here in the sense that they suffered, they lived through the damp, and now while the market was recovering and the retail investor was keep on buying, 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 those guys, the pros, they were actually selling. If you look at the measurement of inflows and outflows, so it looks like in this case the so-called smart money are actually selling and getting out of the market. Maybe they think these full retrace it's a gift because or if you consider where we started to break down, we are back there, so I'm able to mitigate my losses now and selling right around break even and the risk completely my portfolio, hedge fund, whatever you. While instead the buying frenzy on the retail side is a much more present. We did also discuss that overall it's not bad. I mean, it's a strategy which paid out many different times over the last few years, buying the dip, of course. So it's going to be interesting to see who's going to be smart eventually, who's going to be dumb eventually, uh, independently and regardless of the definitions. So we are still seeing a bit of a conflicting type of opinion in the market. Usually, of course, needless to say, usually the smart money are those which are going to win this race, and the dumb money, of course, are going to lose. But there are exceptions to the rules. If you remember 2000, when was that? 2021 Wall Street bets bringing the Wall Street hedge fund managers to their knees, right? So, just because it usually happens one way, it doesn't mean that sometimes it cannot happen the other way around. Now, uh, zooming out at the end of it, and although, I didn't want to bring that up last week because I don't like analogs, right? But so far, we are still looking at the possibility of 2025 looking a lot like 2022. And I know I've been talking a lot about this, mainly when I was saying that, and I still believe in it, right? Mainly, I'm talking about the general environment and the volatility and the violence of potential moves both direction, right? But it looks like so far we are still mimicking what happened in 2022. So again, just take it with a grain of salt. Just because it happened this exact way 3 years ago, it doesn't mean that, first of all, it has to happen the same exactly this year. And most importantly, it's going to happen the same exact way, at the same exact timings, at the same exact levels, drawing the same goddamn patterns. You don't have to take it like this, but just take it into the context of the overall macro and financial environment if you are trading this market. Okay, that's that's where I would leave that off. Now, let's have a look at the SPX. So first of all, when we were talking about the 9 consecutive days advances, and I said, yeah, I mean, but some folks might say, yeah, we got bearish candles. True, we got bearish candles by the definition of them because the close it's below the open in this case. But if you consider the fact that we gapped up relative to the previous day, this is still an advance. This is still the market moving higher, right? I know it sounds elementary and stupid and futile, but you never know who's listening. So again, now we are still looking at the same level of resistance. I'm just taking the S&P as a benchmark here. If you measure, let's say if you throw a fib on the top and the bottom, you see that basically we are hovering around the 618, although, I just rounded it at 62 just for the sake of it. And so far, we are not able to, tap into this region yet. Still thinking this is resistance overall for the overall market benchmark. We might have a bit more of a push into it, but it's not mandatory to be fair. So now we are left out with the same problem. We are kind of stuck in between resistance and support. But let's have a look at these as well. We were looking at the VIX. It kept on coming down, but not as quickly as I would have hoped, just to confirm this thesis, right? Not because I want to see it coming down quickly, but just to see if we touched into one of these two lines, either the diagonal or the 20 level. Not yet, so we're still waiting for it. Now, another thing which might be worth noticing now is if we bring up the moving averages right now. So what we are looking at here is right now the market it's below the 200 in purple and the 100 days moving average in black. But at the same time, we reclaimed the 20 days moving average in green and the 50 days moving average. We are looking at simple moving averages, right? These are not exponentials, just to be clear. So again, we are stuck in between these these moving averages for now. It's kind of relevant if you wish, because if you look back, while the market was rallying, let's take, I don't know, after the pandemic, for instance, you see that we more often than not found support around the black moving average, which was the 100 days moving average, right? So you see the market starts to rally. Every time it gets back into it, it's a decent low to buy, and the market keeps on going to the upside. It doesn't always touch it to the T, like in this case, but more often than not, by the simple slope and posture of the moving averages, you can see that that was a bull market. While instead those moving averages reversed, every rally around the 100 days moving average was used to sell into it, like in here, which again, all this segment right here with the market coming back up sharply, taking out a high, but getting back into resistance. Again, don't like analogs, but you take out the highs, you got back into resistance, and then what, right? So then you got these other spike into it right here, and then you got what? Another rally above it, but still with the 100 days below the 200 days. So when they are downward sloped, every rally into them is a good opportunity to sell into. And then again, we've seen after October 2023, the lows were basically at the 100 days moving average. Even the yen carry trade blew up, right? So now instead we're looking at these black line almost crossing to the downside of the purple. So the 100 crossing to the downside relative to the 200. Will it be another sort of a dead cross? And at that point, if we see rejection here, while these two moving averages cross to the downside, we get into that environment where the market goes down and every rally back to those moving averages is an opportunity to sell into. It's too early to tell, but just to point out that we are again at some sort of a decision-making level, in my view. Either we clear out the 200 days and then 100 days before they cross to the downside, and we resume a more than decent upside, or at that point it becomes a bit more green as a situation. Sure, I think, at the end of it, even if you see, let's say, an initial rejection here, right, and you see the market coming back down, up until the point, I guess, we can maintain these two moving averages right here, right? So the 20 and the 50, which, by the way, the 20 is, it's, if the 100 is trying to cross to the downside relative to the 200, the 20 now, after being reclaimed, is in the process of trying to cross above the 50. So if we can maintain them, kind of like these, maybe it could be a bit choppy, right? And reaccumulate like that, we might see a bit of a head and shoulder formation in conjunction with the moving averages. So a bit of a choppiness in here, while these moving averages all converge one onto the next, up until the point we got a clean break to the upside, if you want to be bullish, right? Or otherwise, the bearish case might be, okay, so there is no bounce, right? We just reject here. We break back below the 50 days moving average. We study step a little bit and we go to revisit around the lows. And at that point, another game would begin, right? So at that point, do we hold the lows, or at least this pocket right here? That if you can see, there is some sort of a gap in here, right? So do we hold this area right here? Let's try it this way, just for the sake of it, okay? Or do we keep on, I don't know, fail another rally and we get back straight to the lows? And at that point, again, you start to talk about, is it a double bottom forming here, or we just keep on going, right? So, but that's way ahead into the future. So for now, I'm just saying, kind of like last week, since nothing really happened this week. Look, if you want, what you could do is, you could, if you really want to be aggressive, or if you want to anticipate things around, which I wouldn't advise, but I mean, your own decisions, right? You could say, okay, so last week we got this as invalidation. You might want to try to bring it up in here right now, considering what we were discussing. As for the moving averages, right? Tap into the 21, push. Tap into the 55, push. So if you now lose either of the two, the 25 or the 21 or the 55, might be your telltale sign that we are set to revisit a bit lower. It could be, I don't know, what could it be? On the S&P, it could be around 5,300, which on this one would be probably, 530, more or less, right? As for the Qs, that would be where? On this chart right here, 450. Let's see on the futures chart. Where would it be? Would be around, let's call it 18,500. If these all move to the upside, starts to crack, right? But again, just bear in mind that same as we had a week where nothing really happened, we might have another one where you got a bit of slow trading, and either of these two cases, both to the downside or the upside, not be completely unfolded. So just give it the time it deserves, right? Remember that, as I said in the beginning, right now there are talks being made at Geneva in Switzerland and between China and the US as for the trade war and the tariffs. So also be prepared for an eventual big gap one way or the other on Monday morning, since we don't know what the hell they're gonna talk about, or It's going to be a blow up, or maybe it's going to be a very gentle type of a handshake and everything is fine from here. So we don't know yet. We'll need to wait and see. I think, quite honestly, it's going to be a big nothing burger, if you ask me. Okay. So, you know, just um, just wait and see. You could also say probably, there is also the possibility that the market won't really give a shit about it. I know it sounds crazy when you say it like that, but look, you know, the at the end of it, we got a few shocks for markets, right? The markets basically rallied up after the 90 days pause as for tariffs, right? So if they don't keep on going now, could this be that what was needed to be priced in is already priced in, right? Then, on the other side, we might say, okay, but even if they come out of the meeting with, a handshake and a lot of good intentions, they might establish a framework, but, actual deals take more time than that in order to be implemented and agreed upon. So maybe the market might be disappointed of waiting in the meantime. And that wouldn't be good for price action, of course, if you disappoint the markets long enough. So I I quite honestly don't know how to take the entire Geneve type of thing for now. I'm just thinking again, since I'm a very short-term trader, I'll just do what the cowboys do. I'll take it as I go. All right, and let's leave it at that. Now, I don't think there is really anything else to discuss, if not a little bit of a hint to this fact. Look, if given the fact that we are closing in on these Geneve talking, like you remember what happened with the UK deal news, right? A massive run up, and then it was a nothing burger in the end. I was particularly critic of it because at the end of it, when you check this out, the US actually has a trade surplus, whether you believe it or not, with the UK. So, you know, is it a massive accomplishment striking a deal with the UK? One of the very few countries with which you have an actual surplus, and maybe didn't even deserve the tariffs, since they're not really contributing to your overall trade deficit. Actually, they should be the ones tariffing you. Maybe, right? I mean, no, I'm just joking. It's just, but then we've seen the market and how it reacted to it. A huge euphoria spike, and then nothing more than that. Doesn't mean that the market is going to reverse. Doesn't mean that the market it's going to be disappointed just by the simple fact here. But it just means that you really need to discern the noise from what is actually impacting and substantial more often than not. So just pay attention to it. Always ask yourself, okay, does it make sense? Does this pass the sniff test? You know, the usual, right? If it quacks like a duck, if it walks like a duck, probably is a duck. Otherwise, they're just selling me smoke and mirrors here, and therefore be ready for it. Again, I'm not consider myself a fortune teller or whatever, but in relation to these Thursday and Friday action, I mean, I immediately thought, okay, so the trade deal, the huge announcement, is it the UK? Okay, how long before the market figures out this is bullshit? Because that's basically what I thought as soon as I saw it. It doesn't mean I'm a genius, doesn't mean I can call whatever. It just means sometimes, rather than your sophisticated tools of analysis and whatnot, a bit of good old common sense and logic can bring you a long way ahead, right? And with that, wish you all a very good rest of your weekend. I'm not sure if I'm going to be able to load up the video this afternoon or maybe early tomorrow because I got a busy weekend ahead. So, but, as for now, I'm just going to edit it. We'll see. Remember, pay attention to what next week is going to bring, especially the Monday Open. And as for the rest, don't be caught up, right? Especially with your pants all down, right? Be nice and be cool as usual. Neil's out.
Mm-hmm. 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 Come on. Mm-hmm. Mm-hmm. Mm-hmm.